All right, welcome to The Explainer. Today, we're putting on our detective hats. We're going to take a single stock chart that tells a pretty dramatic story, and our mission is to figure out what might happen next, using only the clues hidden right there in the chart itself. So let's jump right in. What you're looking at is a stock that has just taken a serious nosedive. After a fantastic run, a sudden 20% drop like this one creates a ton of anxiety, right? And pretty much everyone is asking the exact same question. Is this just the beginning of a total collapse, or is it just a healthy pullback before the next big climb? So how do you even begin to find an answer? Well, for technical analysts, the secret isn't in the news headlines or company reports. It's right here, in the chart. I know, it might look like a bunch of chaotic squiggles, but to a trained eye, it's actually filled with patterns. And today, we're going to learn how to spot them. To do that, we're going to look at the stock story through two totally different analytical lenses. Think of them as two different detectives, each with their own unique method. But they're both trying to crack the same case. Where is the price likely headed from here? Let's kick things off with our first detective, our first set of clues. And this one, well, it's rooted in a pretty mind-blowing mathematical pattern that you see literally everywhere in nature. I'm talking about the spirals in a seashell, the shape of a galaxy, even the proportions of the Great Pyramids. It's called the golden ratio. So in the world of trading, this idea gets applied through something called Fibonacci analysis. The goal is to identify these potential support and resistance levels. You can kind of think of them as invisible floors and ceilings for the stock price. And when you get a bunch of these Fibonacci calculations all pointing to the same price area, well, that's called a confluence, and it suggests a much stronger potential support zone. Okay, now let's see what this looks like in the real world. Take a look at the chart on the left. See all those horizontal red lines? Those aren't just drawn randomly. They are specific Fibonacci levels calculated from the stock's previous big swings. And see that area where the lines start to bunch up and get really crowded? That's our confluence zone. That's the spot analysts are watching like a hawk. So this first method gives us a few potential safety nets for the price as it's falling. Specifically, we're looking at the areas around 323, 317, and 296. Let's think of these as our first solid leads in this investigation. Key battlegrounds where buyers might finally decide to step in. Okay, let's file those away for a second and bring in our next detective. Now for our second clue. This method zooms way, way out. Instead of just focusing on this recent sharp drop, it looks at the stock's entire history, searching for a much bigger, more epic rhythm playing out over years. This approach is called Elliott wave theory. And the big idea here is that human psychology, that constant swing between fear and greed, optimism and pessimism, actually creates repeating patterns in the market. The most basic pattern goes like this: 5 waves up in the direction of the main trend, followed by 3 waves down. It's kind of like the market taking 5 steps forward and then 3 steps back. And here it is in action. The chart on the right is mapping the stock's incredible rise over the past decade as one of those classic 5-wave patterns. So according to this analysis, the stock has already completed that super powerful 3rd wave up, and the drop we're seeing now is part of the 4th wave, which is always a natural correction. Now, each of these waves has its own personality. Wave 3 is usually the longest and strongest. But wave 4, which is where this analyst thinks we are right now, is kind of like the market taking a breather, just catching its breath before the final push higher in wave 5. So knowing what wave you're in helps you get a feel for what might be coming next. Okay, so we've got two completely separate sets of clues. Our first method gave us some very specific price levels to watch. Our second method gave us a location in a much bigger market cycle. Now this is where it gets really powerful. This is the moment in the detective story where two totally different leads suddenly point to the same suspect. Okay, now look very closely here. On the left, you've got our Fibonacci safety nets all clustered together between 296 and 323. Now look over at the chart on the right. The Elliott wave analyst has drawn that red box, marking where they expect this corrective 4th wave to end. You see it? Do you see how those two completely separate analyses are basically pointing to the exact same spot on the map? Both of these methods, done totally independently, are leading us to roughly the same price zone, somewhere in that 275 to 325 range. And when different techniques all confirm each other like this, analysts get really interested. It's what they call a high-confidence setup. All the clues are pointing in the same direction. So what's the bottom line here? Does this mean the stock is guaranteed to hit this zone and then blast off to the moon? No, absolutely not. And that brings us to maybe the most important lesson in this whole detective story. You have got to understand the huge difference between prediction and probability. Technical analysis is not a crystal ball. It does not tell you what will happen. It's so much more like a weather forecast. The forecast doesn't guarantee rain, but it might tell you there's an 80% chance of rain. It identifies the conditions where a certain outcome is just more likely to happen. And that is the key takeaway. That's the secret sauce. All these lines and waves, they're not a crystal ball. They're a map. And a map doesn't tell you your final destination, but it sure does show you the main roads, the potential dead ends, and the most important intersections along the way. It's a map of probabilities that helps you navigate the future with a much clearer plan. And all of this leads to a really fascinating kind of chicken or the egg debate at the heart of all this. Do these patterns actually work because there's some kind of hidden mathematical code written into the markets? Or do they only work because millions of traders around the world believe in them, and by all acting on them, they create a giant self-fulfilling prophecy? It's a pretty interesting question to think about.